welcome to the Mortgage Rate Weekly Market Update for the week of February 24th, 2019. Hello, I'm John Thomas with Prime Residential Mortgage, here to give you your update. Well, mortgage bonds were able to rally last week to move mortgage interest rates slightly lower. If you take a look at the bond chart on the screen, you can see mortgage bonds have been trading in this sideways channel, trapped between this ceiling of resistance and the floor of support. So last week we rallied on Tuesday, you can see with the green candle, but then sold off, hit the floor of support on Thursday, and then rallied back on Friday to again end the week in the middle of the channel. So interest rates did improve slightly. So with mortgage bonds rallying on Friday after the floor of support and being in the middle of the trading channel, we're going to recommend going ahead and floating your mortgage rate to start the week to see if mortgage bonds can improve from here. But if they were to sell off and go back towards the floor of support, we quickly switch to a locking stance. Now, if we dig into the economic news, the big news last week was the Federal Reserve released the meeting minutes from their meeting on January 30th. Now, in that, the big thing there, the Feds had accumulated $4.5 trillion of bonds and treasuries after instituting a quantitative easing, or QE, since the recession started in 2008. Now, after the Fed stopped outright buying of bonds and treasuries, they continued to reinvest the dividends and the runoff on that portfolio back into new bonds and new treasuries. Up until the beginning of 2017, they decided to start tapering down what they were buying. They were buying about $50 billion a month of bonds and treasuries, and the point of that was to keep interest rates lower, to help the economy. So as they started tapering back on the reinvestment, they also started raising the Fed funds rate. So they were doing two things at the same time, which will slow an economy. And they were hoping to get some inflation to kick in by doing this, because they feel inflation's been too low for too long. Now, they slowly did this, about $10 billion at a time. Each time they decided to cut it back, and by October 2018, it was from $50 billion in 2017 down to zero in October 2018, and the theory was they're just going to let that $1 trillion balance sheet just run off as the interest payments came in and loans and treasuries were paid off, to taper it down to zero. Well, they're no longer going to do that stance. They're going to start reinvesting dividends back into bonds and treasuries, and also reinvest any payoffs back into new bonds and treasuries. That is very bond-friendly news, because as we have the Feds coming back into the market to buy mortgage bonds, that could push the price up, which will push the yield or the interest rate down. So we're going to have to see how they institute this reinvestment of their dividends and their runoff, and we'll see how that affects the bond market. But that should be a long-term positive effect if they keep it up. They also hinted that, big news here, they will not probably raise the Fed funds rate in 2019 based on the language they have. So again, that is bond-friendly news, because if they're not raising the Fed funds rate, then it will not be putting pressure on long-term interest rates. All right. Then we saw weekly initial jobless claims come out on Thursday. Claims dropped 23,000 claims down to 216,000 initial claims for the week. This is a reversal of the rising jobless claim trend we had seen. As you can see there, we were at 200, jumped to 253, 235, 239. Now we're down to 216. This also will be the sample week used for the February jobs report, which will be released on March 8th. So that points to a strong jobs report as well. So we'll keep an eye on that. Now, in the housing news, we saw existing home sales for January 2019 dropped 1.2% from December to 4.94 million units on an annualized basis. Existing home sales are now down 8.5% year over year, but the inventory of existing homes for sale is still very, very low at 3.9 months supply, a 6-month supply being a healthy market. Now, the median home price of an existing home did inch up 3.3% to $247,500. So we did expect a drop in existing home sales when the stock market was selling off. People don't tend to go buy homes while their portfolio is going down, so we did expect a drop. Now that the stock market has reversed and is starting to rally again, we would hope to see existing home sales pick up, so we'll have to see if that is true. Now, in the local news, we got a free first-time homebuyer seminar Saturday, March 16th from 10 to noon. That's in Newark, Delaware at the Christiana Hilton Hotel. And then we are back again in Wilmington on Wednesday, March 20th from 6 to 8 p.m. at Independent Small eXp Realty Office. You can register for either one of those events by giving us a call in the office, 302-703-0727, or online, www.delawarehomebuyerseminar.com. And then in Maryland, we are back March 30th in Hyattsville, Maryland. It's a Saturday from 10 a.m. to noon. You can register for that event at 410-412-3319 or online www.marylandhomebuyerseminars.com. Look forward to seeing you guys next week.